Good afternoon, everyone. Welcome to the show. I'm Tanya Tatro from the Tatro Wealth Advisory Group, and today we've got a live Q&A with, all the Tatros from the Tatro Wealth Advisory Group. So we've got my brother, Rob, portfolio manager, Rob. We've got my dad, Claude, on the line as well. And today we're going to be answering any and all of your questions. We're going to be talking a little bit about what's happening in the markets, what's happening in finance in general. And of course, we'd love to hear any of the questions that you have. So if you do have any questions, join us on YouTube, Facebook. Just go ahead and put those questions in the comments section and we'll be happy to answer those questions for you. So welcome to the show, guys. Rob, Claude, how's your week been going so far? I know you guys are super busy this week. Claude, you just got back, right, from a trip?
Yeah, I almost bit my son for at the airport last night at 1 o'clock in the morning. I was coming back from Calgary. I attended some national IROC. That's the regulator. I'm on the national hearing panel for hearings for misbehaving advisors, that kind of thing. So
Nice.
I was at a conference, and then it just happened that Rob came back from Toronto at the same time and we met basically at the airport. Anyways, yeah.
Well, that's great. Awesome. I know, Rob, you're traveling a lot these days too. And I think we should probably at least give a little bit of an update about what you've been up to. You're a little bit more humble, but I kind of want to brag about what you did a couple of weekends ago. Tell us how things went at the World Ironmans.
Oh, the World Ironman. I thought you were going to talk about the awards I won yesterday.
Well, that too. We can talk about that too. Maybe you are humble.
I'm certainly not traveling a ton. I don't feel like I'm traveling way less than I've ever been. COVID has taught us that I think we could do a lot of business from Portage and Maine right here in Winnipeg. So I'm actually super thankful that I'm traveling probably the least I've traveled in the last 10 years. The trips that I'm doing kind of fun trips for races. I did do Ironman World Championships in Nice. So if those of you don't know, Ironman is 3.8 kilometer swim, 180 kilometer bike, and 42 kilometer run. I've been training very, very hard. I did 3 Ironmans this summer, and I did okay at the World Championships. I completed. I finished the race, and I survived the altitude, the heat, and the tough swimming conditions in the ocean that I wasn't used to. And I competed in the World Championships, which is really cool. So I will always have that. And I'll always have this bad boy here, World Ironman Championships.
I'm proud of you.
And there's my time on the back, how terrible I did. It took me 14 hours and 49 minutes to complete this Ironman, whereby I was doing them in 11 hours before. But regardless, I got it done.
You're too hard on yourself. The guy goes to World Ironmans. He's like, oh, I got a crappy time. But let me ask you this question. What was harder, and what did you enjoy more, running across Manitoba for charity or making it to World Ironman?
Oh, running across Manitoba for charity, Tanya, was the coolest thing I've ever done in my life. In my life, it was the most fun and coolest thing I've ever done. I got to run with people. I got to meet individuals that were doing this just for the cause. Kind of the opposite of what I was doing when I was training for this triathlon. When I was training for this Ironman, it was all about me, my goals, my objectives, my races, my personal best, my best time. Whereby when I was doing Run with Rob, it was not about me. It was about the charity. It was about the cause. It was about the other people I was running with and getting them to the finish line. And it was like the opposite. It was intrinsic versus extrinsic. And I loved the Ironman, and I'm very, very happy I did it, and it was super fun. But I missed kind of that, and I'm definitely going to do that again. I'm doing Run with Rob again. I'm doing New Brunswick next year. There you go. I just dropped it. I announced it now.
Oh, now you said it. You got to do it.
I'm going to do it. It was so fun, Tanya. It wasn't harder because I was in such good shape, and every day I was running with different people, so it was fun. I got to run with my dad. I got to run with you, Tanya. You did a half marathon.
That was the best day ever. We all did it together that day. It was amazing.
Yeah. And I'm blown away by how many people came out. 162 people I ran with over the course of 12 days. I'd say 150 of which had never done a half marathon. And a whole bunch are still running to this day. So I know we're supposed to talk about the stock market here, and that's why people tuned in. But it was so neat to have inspired people to actually make positive changes in their life. And I was so humbled by the whole thing. It was the coolest thing I've ever done.
Well, we could talk about the markets all day, but the reality is that, what we do for our clients is so that they can enjoy the fruits of their labor and, do the things that they want to do with their lives. So, you know what? It's always fun to kind of talk about the things that are important to us.
And what are you passionate about in your life right now? What's going
I
on?
I am still like you're doing the whole Ironman thing. For me, it was always still just overall health and fitness. And so right now, what I'm focusing on actually for my training is I'm just trying to get really strong and really strong. So what I've been working on is just like getting back to I used to do powerlifting and Olympic weightlifting years ago. Before motherhood and all of that. So I'm actually getting back to all my my old numbers from before I became a mom. So I'm pretty pumped. I've got I'm deadlifting, like getting almost to double body weight, and same thing with my squats. So I'm pretty pumped. I'm running too though, so that's the other interesting piece that I'm kind of experimenting with is like, can I almost keep up with Rob? Like, I'm not going to do an Ironman, but could I at least kind of like keep up a little bit with Rob on the running as I'm still trying to get stronger?
You could definitely do an Ironman. Why do they call it Ironman? Why is it Iron? It's a terrible name. It's a terrible name.
It is.
Anyways,
what would you call it?
Well, something else. I don't
Iron
know.
Person.
I don't know, but like. I have to tell this story, and then I know we got questions. I'm going to show this question. I was at one of the Ironman and championships, and this guy was saying we're really trying to be more inclusive with the sport. He's like, if anyone's got any ideas for how we can include more women in the sport of Ironman, please let me know. And I whispered to the guy next to me, maybe start with the name. And he like cracked up laughing. He's like, say it out loud. And I was like, no, I'm not going to say it out loud. But I digress. Claude, it's pretty neat. I'm gonna brag about my dad here. It's pretty neat that you're still giving back really to the community, giving back to the regulatory body. You were years as president of IROC, years as you were on the national council, putting the bad guys of our industry in jail. And it's inspiring to see you continue to do that. You fly to Calgary, you sit on a chair on a board, and you hand down fines or suspensions, or I don't even know what you do, but pretty cool that you do that. You definitely don't need to do that where you are now in your life. So kind of neat that you do that, and you're regulating the industry, which is cool.
I think it's amazing. We had an amazing conversation. Claude and I carpooled yesterday or the day before, and it's also really interesting to see also how far the regulatory industry has gone, even just in the last 10 to 20 years, really, since we've been in the business. And it's kind of interesting to see, the freedom that we have now as discretionary advisors and the obligations that come along with that and the responsibility that comes along with that. So
it's not going away.
Yeah. It's very interesting. Just some of the facts, some of the stats is that when I got there, the moderators said, and Claude, I'm not too sure what you're doing here because Manitoba is the only province that has not had one single case go to a hearing or to a trial in the last 2 years. Most of the cases are, I'm not putting Ontario or BC down. There's more people that live there, but Manitoba, we've been 2 years without a case. And the interesting thing is, which is brand new here, they've changed the name from IROC to CSIRO, which stands for the Canadian Investment Regulatory Organization. And they're combining the Mutual Fund Association with the IROC. And it's interesting that whereas we have 30, 40 cases a year of guys like Rob, IROC regulated advisors on the mutual fund side, Manitoba was the third highest province in Canada for hearings and trials and people doing things they shouldn't do, that kind of thing. So very interesting.
Do you think it's a good thing that mutual funds dealers are regulated under the same umbrella as IROC dealers?
No, it's never been, because they're starting to do things on the mutual fund industry, and don't quote me exactly that they're 20 years behind, but there are certainly the regulations that we were doing in this industry that Rob is operating right now in Tanya. The mutual fund self-regulatory organization was different, and they regulated themselves. And the stuff that we were doing 10 years ago, they're just starting to do it now. So what I'm saying is we're about 10 years ahead of time for the consumer protection, the investor protections, and that kind of stuff. So we're mature now, and we've been highly regulated now for many, many years. I remember I started 21 years ago on the board of IROC, and we were complaining over regulation. We still do, but the thing is where there was hundreds of cases when we started, because under these new rules of what you can do and not do for the benefit of our investors, the integrity of the markets and all of that, is that we're very clean. There's very few complaints, and everybody's treating clients in a proper way, and it's really nice to see that older people are not getting taken advantage of, or we don't have any shysters, or very few anyways. They're rare now, and our industry, the way people behave, the Robs and Tanyas of this world, the quality of the people that has really, really improved, and it's really nice to see.
That means a lot coming from someone who's been in the business this long.
Well, I always tell the story, and Rob's probably heard this 1,000 times, but when I started, there was no paperwork whatsoever, right? Everything was on the phone. And we were complaining that it was too much work as advisors to actually have to meet the client and, ask him so we could recognize him if we ever met him again. Everything was done on the phone, and, buy me 100 shares of ABC stock. And then we did it. And then they
hope to collect, hope that they would send a check.
And you hope they would send you a check, right? And so I'm getting off the topic, but it's really, I really enjoyed yesterday. It's probably one of the best days in a long time in my 20-some years of being on a regulatory board, where instead of having all these bad cases where vulnerable older people have been taken advantage of and have lost half their savings or 3/4 of their savings through, I call them still shysters in the industry. Like that, we've had none in Manitoba for 2 years. I mean, it was just so refreshing to see.
And for the record, neither Tanya or I have ever had a single complaint against our behavior. Our record is crystal clean. Let's transition to some questions here, because I don't want everyone to be like, this is a family dinner here with Rob, Claude, and Tanya. They don't see enough of each other. They got to have their family conversations on StreamYard. There's a question here from George. He's talking about, I'll let you do this. Sorry, Tanya.
Perfect. Thanks, George. Thanks for bringing in a question. So happy you could tune in. So the question is, how much uncertainty in the markets today? He read an article that the stock market needs to crash before the bond market recovers. So he'd like to hear our thoughts on that. And also, where is the best place to hide in these turbulent times?
Claude, you want me to start? Do you want to start? Because you were used to.
Yeah, I can start. First of all, crash is the wrong word. I mean, the markets are going down.
But to be clear, Claude, the question is, the stock markets need to crash.
Oh, I see.
Before the bond market recovers, is the question.
No, we don't need to crash, but it's healthy to correct, because market, like companies don't go up and down 10% their earnings, from day to day, from week to week. It's a long term, but the markets are liquid, and it's people buying and selling. And when markets go up too fast, then they got to correct and come down, and it's healthy and it's needed. The key point is very simple, is that if I had more time, I'd say that, if we use the word crash, I'd say that, I saw it back in 81. It was the end of the world. 3 years later, we're all-time highs. And then in 87, we had the still to this day, 23% down in one day on October 19th. 1987, it was the end of the world. And I even felt it was the end of the world because I was relatively new in the business. And how much are we going to crash? Is it the end of the world? And guess what? That one was 7 months later, we hit new all-time highs. And then I'm not going to mention them all, but then we did, I remember the fall of 81.
The year of God.
It was the end of the world. And guess what? The summer of 82, 9 months later, all-time highs. And then we hit the Asian crisis in 98. It was the end of the world because Asia was involved. It was the end of not just Canada and the US. It was the whole world. It was the end of the world. And guess what? 2000, we had new all-time highs. And then, of course, we had what I call the real crash, the dot-com era, where some stocks, it took many, many years to come back because they weren't quality stocks and that kind of thing. It was the end of the world there too. And guess what? We made up new all-time highs about 3 years later. And then the big one, to me, the biggest in my 40-some years was the 08-09 financial crisis, because when it's financial, it's pretty serious, right? It's the banking system, and it could take the world down. But guess what? It started in 08, and guess what? In March of 09, we started turning around, and a few years later, all-time highs. And then we can talk about COVID. Anyways, it's the same. I've seen this movie before, and I know the end. And it's not fun right now, but we will have new all-time highs. It's just a matter of, will it be 6 months, a year, 2 years? I don't know, but we will have new all-time highs.
I'd also like to hear both of your thoughts, though, on this idea of, is it good for the markets to correct for in order, for the bond market to recover, like the give and take between those two? I'd like to hear your thoughts on that, and then also like where to hide, right?
Okay, so the thing with markets is you cannot participate in an asset class that is going to generate double-digit returns without giving up something. And in this case, if you own stocks, you're giving up you're giving up your stability. You're taking on more volatility in order to get that higher return. When we talk about alts, we're talking about maybe less liquidity or less ability to get out on a daily basis. And that's what you're giving up in order to get double-digit returns. With stocks, you're giving up stability. You're getting more volatility. So it cannot happen. You cannot get these types of returns without getting these periods of volatility. And we're talking today about a roughly 7.5% drop from where we were a couple months ago. So yes, this sucks, but these are roughly once or twice per year that on average, the market has corrected kind of roughly this much. So we know they come, we know they happen. And I don't know if the viewers and the ones watching are feeling, and I'm not the best person to ask because I'm completely emotionless when it comes to this. So I don't know if the viewers or watchers are feeling that this is worse or similar to other 7% corrections. Maybe they're feeling it's worse or better, or maybe they haven't even noticed. I'm not sure. But like for us, we know that these come, and when they do come, we've seen them before. And then your second part, Tanya, is how to, what was the question? Where to hide?
Where to hide? But maybe the answer is maybe you don't have to hide. Right?
You don't have to hide. If you have a portfolio manager that's built a portfolio for you where you're properly asset allocated, you have a portion of your wealth today that is hiding from this stock market volatility. If you're one of our clients, I guarantee you have a portion of your wealth that's not down 7.5%. And if you're conservative, it's probably more than half your portfolio. And if you're kind of aggressive, it might be a third of your portfolio. But all of our clients have a portion of their wealth that is hiding, whether it's in fixed income or private debt or alts or private real estate, whatever it may be. That's how we think that clients should hide. It's not that you make a spur of the moment decision today to decide to hide. Oh, today I'm worried about the market, so today I'm going to hide this 50% of my portfolio in cash. Well, we know that's not the right move, and I can explain it why. But basically, we know that we don't know where the bottom is. And because we know that we don't know where the bottom is, you have to remain invested. Now, you can do tactical shifting. You shift a little bit in and out when there's extreme oversold situations or extreme overbought situations. But like, that's not how you manage money. That's not how you protect capital. That's not how you do a service to your clients, by acting in their best interest and as a fiduciary of their wealth. We are custodians of our clients' wealth. We have to manage that money like it's ours, or like it's, you know, my uncles or my parents. But I use the parents as example. That's a terrible example because my dad, you know, knows what's going on in the market. Anyways, Claude, I don't know if did I answer your question, Tanya?
I think so, and I think
I'm going to go one step further to say that in my experience is that when people are afraid, like today, you know, like we've been down here recently, and they call and they say, you know, like, why don't we get out and, you know, hide somewhere, and, you know, I can get 6% right now or 5.5%. Well, experience has shown, and there's stats that show this, is that the people that get out of the stock market because they can't stomach it, or it's too volatile and they're afraid, I'm going to lose, it's different this time, and all of that, history shows that they never come back. So fine, when they sell, that means we're probably close to the bottom, and then they never get back in, and then they lose. What we're trying to accomplish is to get, you know, good returns through equity ownership in the markets. So I totally disagree with trying to be smart and say, you know what, market's going to be down for the next 6 months, so I'm going to hide in a 6-month GIC, and then I'll get back in the market. It never happens.
Yeah, you're giving up the future returns. And if you're going through that period of time where you're unsure about, and you actually are losing sleep and it's really eating you inside and you're having a hard time, then you probably should having a further discussion with your advisor about the asset allocation, or, you know, the risk tolerance, because you know, that's not something we want for our clients. Like, your financial health, yes, there's going to be bad parts, just like cheering for a hockey team or a baseball team. You know, the Jays lose, they score 1 run in 2 games, you're a little frustrated, but you're not like throwing in the towel and conceding and selling all your Jays gear. Maybe that's a bad example, but you do want to own some stocks long term, and there's a reason you own them. Our job is to figure out the percentage. Should it be 30, 40, 60, 80, whatever percent? That's our job to figure out. We need to make sure we're a fiduciary of your wealth.
Yeah, I think there might be even, you know, this perhaps a misconception. It's hard to say that, you know, because of our knowledge of the industry and the markets, that somehow we have some kind of extra additional insight that would allow us to and maybe we would be slightly better at timing the markets if we actually tried than, you know, a standard person who was just taking a guess. But I think that there is this this misconception that active management of a portfolio means making predictions of making short-term predictions of some sort, right?
That's speculating, right?
And that's exactly it. It's speculating. And so I think it's really important to be preemptive, not in the sense of trying to predict, but to be preemptive, like Rob says, in terms of asset allocation, and really trying, like, this is what we do. This is Rob and I's job, is to really try to walk a mile in our clients' shoes and say, okay, well, how would we feel? Would we lose sleep overnight the next time we have a crash, or the next time we have a 20, 30% correction? So I think that's the more important question to ask yourself as an investor upfront, is, you know, knowing that these things will happen, that recessions will happen, that crashes will happen, that corrections will happen. How am I going to feel? Am I going to lose sleep knowing that, you know, I might have to experience a little bit more ups and downs before I kind of see that long-term paycheck, you know, at the end of the day? So I think that's a good way to position oneself, as opposed to trying to be reactive.
I like it, Tanya. And when you make decisions and plans in times where the markets are neutral, or times are not panicky or euphoria, you end up making rational plans, which is why when we make plans for our clients, we always make sure to review them. Obviously, we review them regularly, but we review them in times when the markets are not toppy or bottomy, because you end up making the wrong decisions for the wrong reasons at the wrong times, right?
Absolutely. Yeah. So it's good that we got kind of this initial discussion, because I think this is probably one of the most common things that we get, both from, you know, prospective clients are kind of asking us questions, but even from clients, sometimes we'll get the question, well, is now a good time to invest? Shouldn't I wait? Should I wait till this recession is over? Or should I, so, and the answer is going to be no. What we have to do is we have to act in your best interest now, knowing that, yes, this eventually, we don't know when, but things like this will happen every once in a while. Like you said, twice a year for this kind of 5 to 10-ish% corrections. And then if our viewers are kind of trying to figure out the lingo here, so when we talk about corrections, generally we're talking 5 to 20-ish%. And when we're talking about a crash,
well, you got a bear market at 20, and then you get a crash at, typically they'll say 30 or more than that. So a correction at 10, a bear market at 20, a crash at 30 is typically the vernacular that they use. But the other question might be, okay, I'm seeing this 5 to 10% correction, but what if it turns into a 20 or a 30, right?
Mm-hmm. Yeah.
And that might be the
perfect. Great buying opportunity.
There you go, the optimist there.
Yeah, but we're not trying to make light of the fact here that
No.
we know that this is emotionally tough. We know it is. It's what we do for a living, right? So we talk to clients and we know it's emotionally difficult to see. But remember, there's never been in the history of stock markets a correction, a bear market, or a crash ever that's not made a new all-time high. So that's coming for sure. Now, we probably want to talk about this specific movement in the market, these last 7% movement in the market over the last month or so, what's causing it and all that. And we can get into that, or I can maybe address some of these questions, but it's largely, sorry, go ahead.
I was going to see if we have any additional questions.
These are a little more complicated questions, but I thought we might.
Maybe we should first talk about kind of what's happening right now, whether, what's unique to this particular situation. Because I think the other thing that's coming into play here is that traditionally this time of year is also a little bit volatile, right? Lots of money in movement this time of year. So that's, something to consider. But also, obviously, we've got things happening in the world economy as well. So maybe we can address kind of the big talking points there.
Yeah, I'm trying to pull up a chart here. Yeah, here we go. So this is the seasonality index. So this is September, October are historically bad months. Now, that doesn't mean that every single October, September is going to be bad, but this is every September, October. This is what they look like. So this is the month-by-month return since 1950 of the stock market for each of the different months. And then this is the month of October. So we know that there's been crashes towards the late October. So that's why. But historically, this is what it looks like. And this one I wanted to share with you guys too. Is October really the month where the market bottoms are made? On a relative bottom, yes. Since 1945, the number of times a pullback has ended by month. So more often than not, October actually ends up being a bear market breaker or a recession, or not recession, sorry, a crash breaker more than any of the other months. So 5% pullbacks have ended in October more than others. These are some other charts here, but I was going to
and you were saying we're at like a 7-ish% pullback right now.
Yeah. Now
we're at an all-time high. Yeah.
We're at 7 from where we were 2 months ago. And now the Dow has turned negative on the year. The TSX has turned negative. I believe the NASDAQ and the weighted S&P, equal weighted S&P has also turned negative. So really you have basically kind of 7 or 8 stocks in the US that are very positive. That if you happen to not own those, you're negative this year in all of your portfolios across the board this year, 2023. Now, we know that this is being caused because there's a fear of a potential recession. We know this is being caused because there's now a sentiment that this inflation is going to be sticky. It's going to stay around for a while, and we're not going to be able to buy our basket of goods for 2% more than it was last year. High inflation means higher interest rates, because what do we do when there's inflation? It's a lever, right? So you pull on it, you pull on interest rates, and in theory, inflation goes down. That's how the lever works, right? You pull on interest rates, inflation goes down. So they've been doing that aggressively, the central banks. The fear is that it's not going to be enough, or it's going to take more, and we're not quite done. And then the longer interest rates stay higher, this is the fear. The fear is that the longer interest rates stay higher, the more pain there's going to be, the more people are going to lose their houses, the more people are going to lose their jobs. And that's the fear. And those are all kind of potentially real fears. Like, it's understandable that to be fearful that, your buddy might not be able to afford his mortgage on his payment or whatever, because he's going to have to renew at 6% instead of 3%. But all this to say that companies that you own, that we own for our clients, we believe they're going to continue to be profitable. We've seen this movie before. We know, as my dad would say, that yes, there's problems in the market from time to time. And I can list you hundreds of problems that have happened in the economy over the last 100 years. And every single time companies end up being profitable, right? So, you're talking about planes crashing into the World Trade Center. You're talking about banks failing. You're talking about Ebola crisis. You're talking about financial crashes in the 07. You're talking about oil embargoes, World War I and II. Hello, we're talking about a Great Depression. Okay. So if we're just talking about inflation, Claude, you can talk about 1980, 81, 82. We've seen significantly worse than this, and the country didn't go bankrupt, right? What ends up happening is we figure it out as a society, right? We figure it out because we tighten our belt, we make it work, and companies remain profitable because we choose to spend our dollars where they matter, and the good companies remain profitable. I'm maybe oversimplifying it, but 5% inflation is not something that we've never seen. You can't say that this time it's different because we've never seen 5% inflation or 4% inflation. Geez Louise, we saw like 18% inflation, right? And like 20% interest rates. And, we saw new all-time highs after that. So I'm not trying to belittle it. I'm just trying to put it in perspective.
That's a very good point, Robert, because it was the end of the world back in 1980, 81 there, because, all of a sudden, we're paying 16% on our mortgage. We're not talking about 5 or 6 or 7 here. And at that time, this is the end of the world. Like we'll never make money again, and every company will go bankrupt. And well, guess what? I said earlier, back in by 1984, we were back at all-time highs, and there's short-term pain. It's painful, but we will get over this, and we will have new all-time highs. I just don't know how long the pain will be, but we need to fix this inflation. And if it takes another 6, fine. Another 6 months. If it takes another year, fine. If it takes another 2 years, but we have to fix it. And the two banks, the Canadian Bank and the U.S. Federal Reserve and Bank of Canada, are actually doing what it takes to fix the problem. And you can't fix sometimes problems like overnight. It takes time.
Do you ever see the interest rates going back to kind of those mid-teens like they did back in what was it, like 80, 81 or?
No, I don't see it, because the difference is just like we had no computers before. Now we have computers, and life is changing, and the reason is now that the Federal Reserve in the U.S. and the Bank of Canada have a lot more tools in their toolbox, and they have a lot more information. Nowadays they have all the stats on a weekly, monthly basis, and there's ways, if we use the monetary policy, to make sure that inflation doesn't go up to 18%. The wild card in this, though, is fiscal policy, where that's a political decision, and a government can decide to, overspend by 10 billion, 100 billion, which creates inflation. And then you have the Bank of Canada that's trying to rein it in. So, but we have the tools. I'm confident that the people, running our countries on monetary policy will get it done. I'm very optimistic.
I was speaking with former Prime Minister Stephen Harper yesterday. I met him in Toronto, and he's an economist by background. And I asked him these exact questions because I don't want to be political in any way at all whatsoever. But, it's kind of neat whenever you get to speak to a former prime minister who's an economist. And the guy was so well-spoken, and he was so, I don't want to say he said pretty much exactly what you say, Claude, but, he was optimistic long term that the best thing that ever happened was transparency in the monetary policy in order to control inflation. Because I asked him about this, are we going to see this 18% inflation? And he said pretty much exactly what you just said, Claude. So you and Stephen Harper apparently on that point think alike. Tanya, maybe go ahead.
Should we take a look at?
There's some questions here.
Perfect. We'll take
let's
a look at some questions.
This one here. It's a longer question.
Okay, so this one is from Sean on Facebook. Awesome. So we've got people listening in on Facebook. Speaking of which, if you are right now, YouTube, Facebook, any of our socials, please like, subscribe, go ahead, put some questions in the comments for us here. And let's go to Sean's question. So what would your advice be to this? If in the near future, let's say 6 to 8 months from now, you're going to walk into some money, but currently you have some debt, not high interest debt, but some line of credit. Now, because the market is lower, would it be wise to invest at these lower stock prices now and wait to pay your debt off when you receive the lump sum in 6 to 8 months? Oh, that's an interesting question. So I guess Sean is looking to know whether he should take the opportunity to buy while prices are low, even if it means having some debt hanging in the air.
So this is tough because we can't, we can't really give advice to people without knowing their personal situation.
Yeah, we don't know what interest rates you're paying on the line of credit. We don't know what your portfolio looks like, what your risk tolerance is.
But the question of whether or not you should pay down debt or invest is almost always one. I think we have a YouTube video on this. I'm not sure. It's always one that ends up being a personal choice because it ends up being an emotional choice, not a mathematical choice. Because mathematically, unless you're kind of in the 80s and we see kind of 12% interest rates, you're always going to be ahead long term, always going to be ahead, leveraging, meaning investing your capital and keeping your debt. So not paying down your debt. You're always going to be ahead mathematically. No, that doesn't mean
let's add 1 million point. As long as your portfolio, your investment is doing more than the interest that you're paying.
Obviously. Yeah. If you're one of our clients, let's put it that way.
Okay.
So that means that the reason that you would want to pay down debt becomes an emotional choice because you're having a hard time carrying that debt. You go to bed at night, you're like, oh my God, I owe 500 grand and I have 500 grand and why don't I just pay that? Wouldn't it make more sense? Mathematically, you're not better off because that 500 grand is going to grow. Let's use 8% and you're going to pay 5, let's say. So you're growing by the spread of 3% per year, whereby if you just pay down the debt, now your balance sheet shows no assets, no liabilities. So you're not growing at all. Right. So it's not a mathematical question. It's an emotional question, Sean. And I'm not comfortable giving you that piece of advice without talking to you over the phone. So you could book an obligation consultation. You could go to speakToRob.com. Be happy to do that.
Yeah. Get a little bit more information on your situation and go from there.
How about this one here? Question about moving alts. Tanya, do you want to take an alt question?
Yeah, let's do alts. That's a great one. So Edward's got a question on YouTube here. Have you come across any new alternative investment opportunities? Well, we always have new alternative investment opportunities, and obviously it's going to be different for each client. But perhaps we could chat a little bit about kind of broadly some of the big categories of alternatives. So we've talked a lot about private real estate. That's something that has really helped kind of stabilize some of our clients' portfolios over time. Other big categories could be things like private equity, private debt. But maybe we can talk about like the lesser kind of known stuff, maybe farmland, music royalties. I don't know if maybe you want to chat a little bit.
Yeah, I don't want to talk too much because there's a lot of other questions here and I want to get through some stuff. But basically, yes, we're always looking at, so music royalties is a very stable asset class that we like to own. Private infrastructure is one that we believe in. Storage is one that we believe in. I believe there's not going to be a shortage of storage. Farmland, in addition to the kind of stables, which are private real estate, private equity, and private debt. Those are kind of the three common ones that most people own if they're at a competitor. We look at way more than those. So there you go, Ed. Now, I think I want to address this question here real quick. Why wouldn't you just build a portfolio that's exclusively alts? And maybe Claude can speak to this or I can speak to it. I do want to give my dad a chance to speak because it's all about diversification. I'm sure my dad will say, Why don't you basically, if alts are non-correlated to the stock market and there's so many options, why can't you just build a portfolio of alts? Claude, I don't know if he's frozen.
Well, I mean, it's a tough question to answer because alts encompasses a whole bunch of different investments, right? Whereas the stock market, it's equities and it's growth. So if we're looking for no volatility and never having to worry that people have mentioned there's a crash or we're down 8% in the last 2 weeks, you would want 100% alts because there's no volatility. However, in the long term, you're not going to get the type of returns that the equity markets, ever since America was formed 200 years ago, that you get in equities. And like Rob really said it well a while ago, is that you're going to get, historically, we have always had great returns in equities, but it comes with pain in times like this when you're down 7% in 2 weeks. And so you have a choice to make. Maybe I'm not answering the question, but if you go all in alts, you're not going to have that pain and you're still going to do very well, but you're still not going to do quite as well as if you have equity.
What are you giving up? You're giving up returns potentially over the long term. You're giving up some liquidity, and then you're actually concentrating your risk in one asset class, which is the opposite of diversification. That asset class might be, real estate or infrastructure or whatever. So really our job is to diversify. So you are taking on more risk in owning just a single asset class, right?
I would say that's probably the biggest thing. We always say never put all your eggs in one basket. Even if that basket has some pretty nice looking eggs in it, we want a few different baskets.
Claude, I'm going to show you this question here from Greg. Okay. It's about short sellers, and I don't. So Greg's asking, short sellers seem to be in control of the markets. Even terrific quarterly reports bring short-lived gains and continuing declines. So the question is this a fair assessment of markets for the near future?
No,
I don't. Yeah, I
absolutely not.
Yeah, because
please elaborate.
Well, it could cut me off, Rob, because it could take me a couple of weeks to answer this one.
I got to cancel my kids' swim class tonight.
Okay, when you're shorting a stock, you're hoping you don't collect dividends, first of all, so you're doing the opposite of what you should be doing. If you short a stock, you pay the dividend rather than keep it. Okay, so it's costing you, and long term, I mean, markets go up, and we've had 10% returns. So if you would short all the time, you would lose.
It's a losing game. It's a losing
8 to 10%. Now, I do agree with part of the statement this gentleman said, is that you can get lucky over a short-term period. But that's almost like gambling or speculating to say, well, the market's going to go down for the next 3 months, so I'm going to short a bunch of stocks. There's better ways to do it. You could sell option. I'm not going to get into that right now.
Yeah, and just to further quote, I don't think he's suggesting shorting. I think the question is, do the short sellers have control of the market? And I would argue, no, they don't. Yes, there are some short sellers, the Citrons and the Andrew Lefts of the world, that try to make sensationalistic splashes when they decide to short a company, but they're trying to make one trade. They're not trying to ruin the market. They're not trying. This might be a question that has to do with the movie that came out about the GameStop saga. This possibly someone who saw that movie or saw that preview and is thinking, oh my God, these short sellers, they stuck it to Wall Street. And if you think that, you need to watch my video on my channel. I forget what it's called. I think it's like reviewing the GameStop saga, Diego, or I forget what it's called. I'm asking producer Diego, but I give a pretty intense opinion as to how that movie got it wrong. They think that like the little person, showed them. We showed Wall Street, but most of those people went bankrupt. Most of the people ended up shorting. They ended up doing it at the absolute wrong time, and they got cleaned out, unfortunately. And yes, they ended up not allowing them to sell their stocks. And I know that Robinhood, whatever the behavior that happened there is another debate. But at the end of the day, a lot more people lost money. Little people lost money than made money. So the short sellers, in my opinion, are not in control of the market. We have a phenomenally transparent market. Short sellers bring liquidity, they bring transparency, they bring the opportunity to have a more efficient market, most would argue. And I don't think short sellers are ever going to go away because it's a losing game long term.
And one further comment about, are they in control of the market? The markets are too big. I'm talking about, the stock, the New York Stock Exchange, and those quality companies. It trades billions of dollars every day, so nobody can control that. Where you read the stories is probably when you have an illiquid, maybe penny stock like a GameStop. There, it could happen that people can manipulate and be in control of the market, as you say, the shorts. But it has to be a very illiquid stock, and we don't trade in those kind of stocks.
No, it's too risky. It's too speculative. And maybe the last part of your question, Greg, is terrific quarterly reports, stocks still go down. Well, that's maybe more of a market sentiment generally, right? If everyone's unhappy, you throw the baby out with the bathwater. The good stocks get sold, right? There are bank stocks today that are yielding 7.5% or something. Like, there's some really good stocks that have been sold. And I want to say this. I'm name dropping like crazy here, Tanya. I dropped something. It's a name. Tony Dwyer yesterday in Toronto. He came up to me. He's like, Rob, good to see you. And we ended up chatting about this market. And I said, how close are we to this mini bottom of this little correction? And he says, Rob, we're there. Like, don't take this as investment advice. But he said, I follow the stochastic, I follow the MACD, and I follow, he told me the technical indicators that he follows. And I actually pulled it up here if I want to share my screen, but it's a little, can I share? Anyways, he says basically the stochastic indicator is roughly where it was at the bottom of COVID. And the percentage of stocks above the 10-day and 50-day moving average are among, the most oversold that they've been. And he's like, that doesn't mean we're out of the woodwork yet. We might see November issues with this potential recession, but right now, on a relative basis to earnings and to momentum, these stocks are oversold. So it's not fun when the stocks fall, 7% in a month, but usually you're at a mini bottom when that happens.
Yeah, it's tough to make the argument that, that movements, small movements in the market with either like a very specific thing like a GameStop or smaller short-term movements that are specifically based on investor sentiment as opposed or just news or, like just generally how people are feeling in the market. It's tough to make the argument that's who's, controlling the entire market kind of, in terms of Greg's initial question, right? Because we're looking at kind of short-term investor sentiment changes or a specific stock. So that's really different than, something that affects the entire market, like large cap,
Yeah. There's the stochastic indicator. It is below any number. It's the most oversold. It's been the 14-week stochastic in a long time. And then this is the MACD, the 10-day moving average, 50-day moving average, convergence, divergence. It's among the most oversold right now that it's been in the last kind of 5 years. So just thought I'd share those charts with you guys.
Can I just add too that even though, as we're talking a lot about, I feel like we're talking a lot about markets today, and, we're also talking about kind of, the long-term prospects for, good companies that are profitable, and clearly we're long on equities in the long term, right? But, I think I just want to touch too that, look, not everyone should be in stocks, right? This is why it's important to have an advisor, right? Not everyone is wired to be able to manage that kind of volatility on a day-to-day basis. And that's, it's just kind of, each personality is different and each person is in a different situation. So I just wanted to quickly touch on that too, because as much as we keep talking about, how, we're confident in long-term prospects for the market, let's just get it out there too, that it's not for everyone.
Absolutely. Great point, Tanya. Yeah, we definitely don't force anyone we don't jam equities down anyone's throats. We have no interest in doing that, right?
Yeah. So let's see if we have any other questions that are coming up.
Maybe one more question. I did a video on this, but maybe I can address it quickly here. It has to do with private REITs. Mortgage rates increasing. How are the returns sustainable? So in other words, if interest rates go up, so if you're a private REIT and you own debt, you own properties and you have debt on the property, debt is your most important expense. So debt goes up. How can you distribute the same amount of cash flow? Well, the quick answer to that is you get an increase in net operating income by charging more rents. So interest rates have gone up. We know that. Most of these private REITs have their debt laddered over 5 or 10 years. Let's assume most of them are 10 years. And let's assume they've evenly laddered them over 10 years. So 10% maturing this year, 10 next year, 10 the year after. That means 1/10 of your debt is being renewed at a higher number every year. So if you're going from 3% to 6%, that's 3%, but it's 1/10 of that. So you're moving by 0.30% your total cost of debt. So that is not dramatically changing your your profit, your net operating income on a year-to-year basis. What is 20% increase in rents over the last 2 years, 10% per year increase in rents in most large Canadian markets over the last 2 years, anywhere from 12 to kind of 25, depending on the market. So that is going directly to your bottom line, right? So most of these private REITs, yes, they have higher costs, but it's been offset by higher returns higher rents, to answer the question.
Which is an interesting and important point in times of high inflation, right? We want to be looking for asset classes where the increased cost of doing business is passed along so that there's increased returns, so that the investor can then capture that increase too, right? So this is this is one of the asset classes that can act as a type of inflation hedge, because it's capturing the increase in rent as well.
Yeah.
So the question is, I was going to say, I'm kind of thinking maybe we do, if anything, one more, maybe, and then we could consider kind of wrapping it up here. So we maybe get it done in an hour.
This is a good question from Rodney. Very good question. And I think I know what Claude will say.
Okay, I'll read it off and we can decide which of you wants to answer here. So Rod's question on YouTube is, at what point of the work/retirement cycle should a couple start looking at moving away from a stock-concentric portfolio?
Claude, before you answer, it would be a really fun game. It'd be like one of those, what do they call them? Like
blinds. You each answer separately, and then and then you show the answer.
What was it called? Maybe the newlywed game or something like that?
Game, or I think it was the newlywed game.
Yeah. So name the place where you had your first kiss, and then we both show something, and oh no, it wasn't there. Claude and I think we would match this, but I'll let you answer first.
No, I there's not enough information. Like me, I'm just because I'm old, I'm still, let's say, 100% stocks. If I really, and if I need money, I can sell part of my stocks.
Claude, you have alts in your portfolio. You own a lot of private real estate and real estate.
Yeah, yes, I do. But
I actually had this conversation this morning too, so I can't wait to see what Claude will say.
Well, anyways, the point is, it depends on your needs as you get to retirement, right? So without knowing that, I can't really answer that question.
I think what I would say, and I thought you might say, Claude, is you're not dead because you're turning 65 and you're retiring, right? It used to be back when you started in your career, life expectancy was 65 or 70, and you would plan for people to die a few years after their retirement. So they didn't need to plan for 25 years in retirement. Today, we know on an actuarial basis, a couple that are both 65, there's a 30% chance that one of them will live in their 90s, right? Or a 40% chance, I think. So we have to plan for that as a very real possibility. So you're 65, you're not dying. You have 5 more market cycles, right? 5 more 5-year market cycles. So there's no need to immediately convert all your portfolio to cash, because what would that do? It would cost you money. There's an opportunity cost to be sitting there. So what we do, you're right, Claude. Do you need income? If you need income, all right, let's adjust the portfolio a little bit for income. But should you give up returns just because in 35 years you might be dead? No, there's 5 more market cycles. Now, if you're having a hard time with the volatility, that's one thing. But typically that doesn't change from the day before you retire to the day after you retire. Your emotional well-being with respect to your stocks doesn't change overnight. The one thing that has changed is income instead of drawdown. So let's address that, which is we need to now make sure the portfolio is generating income to meet Rodney's needs. But aside from that, the risk tolerance, hasn't really changed. You're not dying tomorrow. You don't need to go all cash. Plus, you're not going to draw down all of that portfolio overnight. Yeah. Sorry, Tanya, I interrupted.
That's exactly what I was going to say. If we were doing the Hollywood Squares or whatever, newlywed game or whatever, I mean, the answer to that question is maybe before, maybe after, maybe you never change, because the reality is your risk tolerance hasn't changed. The only thing that has changed, like Rob said, is your need for income rather than you adding to the portfolio. So that's the point that you want to address. You don't need
we address, like, let's make sure we address that, obviously, the need for income. And maybe you go out of growth stocks and into dividends or whatever, but that doesn't necessarily mean you sell all your stocks. And that's a big misconception. And I'd say a problem in the financial planning world and what some institutions are pushing. And I'll argue even a little bit further is if you're in the 1% and you're, call it, very wealthy, and you're going to have an estate, right? There's going to be a chunk of assets that are going to be transferred over to the next generation. An argument could be made that you should actually never change your asset allocation, because those funds are going to go to your kids or your grandkids, which have probably a very long investment horizon. So now we're not talking about a 5 or a 10-year investment horizon. We're talking more about kind of permanent, multi-generational wealth, which should probably have more of a pension style approach than a what's your life expectancy approach. Because what typically happens if you go to like some of the large financial institutions, that you'll retire, they'll drop your equity exposure, and then when you're 70, they'll drop you again. When they're 80, they'll drop you again, and by the time you're 85, you have no stocks, which might be right for some people, but I'm saying it shouldn't be just cut and dry. Like it should be an open discussion with the client. What's happening with these funds? Yeah, how do you feel about
the key is where is the money going? When you die, right? Anyways.
Yeah. Yeah. And that's a really good question, because we actually get that a lot. This is a really kind of common situation. Also, a lot of those, target date mutual funds are also set up in that way, right? So there's always kind of that, do I need to be doing something as I retire? Well, yeah, you do need to be planning for retirement, but it doesn't necessarily mean
those things are terrible. Those things are downright terrible, and their performance has been terrible. They think they're doing a favor by automatically rebalancing someone without talking to them, without getting an opinion as to how they feel about their investments, and they give up return long term by automatically reducing their exposure to stock. And meanwhile, the clients suffer. They end up getting less returns. No one's talking to them, filling them in about maybe their risk tolerance hasn't changed. Anyways, I have a strong opinion on those, I guess.
Yeah, so I'm sorry I brought it up.
Tell us how you feel about these funds, Rob.
All right. So unless
there are some other questions, but we're pushing into an hour here, so we should probably wrap it up. But the good thing is we could do this again.
Yeah, we'll definitely do this again. So, before we sign off, give us a like, give us a subscribe on all of our socials, and we'll also keep all your questions in the comments for next time we come on. We'll answer those questions next time.
Thanks, guys.
Have a great weekend, everyone.